In this short video, I'm going to go through the reducing balance method of depreciation. But before I actually go through it, I want to explain the difference between this type of depreciation and the straight line depreciation. Straight line depreciation is more of a simple approach in that if you have, say, a machine or a car, we'll keep the car as our example, a car being worth €5,000 will lose value over time. So by the time you sell it, you'll sell it for scrap or salvage value, and it'll obviously be a lot less than what you paid for it initially due to the wear and tear. So straight line depreciation would be, say for example, if you apply a 10% amount of depreciation on that €5,000, it will reduce by €500 in the first year. But the second year will also have a depreciation value of €500. So the same fixed amount due to the initial 10% depreciation value will see a deduction of the price of that car or the value of that car by €500 for each year, so that at the end of year 2 it'll be worth 4,000, at the end of year 3 it'll be worth 3,500, and at the end of year 4 it'll be worth €3,000. So again, just a straight line or a fixed amount of a depreciation for each of those years, €500 each year. Reducing balance depreciation, however, is where you actually subtract the same percentage, so we'll give it 10% again, the same percentage amount from each of the book value after each successive year. So say for example, your car being worth €5,000, you apply again the 10% depreciation value on that. So at the end of the first year, your car depreciates by €500, giving you a value of 4,500. Very similar to your example on straight line depreciation, but the difference applies in the second year. You apply the 10% depreciation value on the current book value, which is now 4,500, so that your depreciation value is €450, 10% of your 4,500. So at the end of year 2, your car has depreciated by €950, 500 in year 1, 450 in year 2, now valued at 4,050, whereas a straight line depreciation had a deduction or depreciation of 500 in each of those years and is currently worth €4,000. So you see your car is worth a little bit more with reducing balance depreciation. Again, if you apply year 3 to 10% on that, so your car being worth €4,050, your car gets depreciated by 405, or 10% of the €4,050. So instead of having your straight line depreciation of €500, it gets deducted by only €405. So the formula that we're going to see here, D is equal to B times 1 minus R to the power of N. This might appear similar if you had looked back on the video where we did compound interest. Compound interest was very similar, except the difference here in this formula is that we have a minus as opposed to a plus. Everything else is pretty much the same. And if you think about it logically, compound interest means that the value increases over time, so that's why we have a plus or, and depreciation here sees value declining over time, and that's why we have a minus or. So D is your depreciated value, B is your book value or your depreciation rate, and N is the number of years. So let's take a look at an example of how we would find the depreciated value of an asset. In this case, it's a building, given these figures. It costs 5 million. You decide to depreciate it by 10% per annum using a reducing balance method, and we want to find out what the written down value or the depreciated value or scrap value is after 25 years. So we should know by looking at this, hopefully, that it's easy to find out N is 25 or is 10%, but the building cost, which is your book value, is €5 million. And now we want to find out what D is. Plugging all those values into the formula, straightforward enough, hopefully. We won't forget that this is a negative in here, so 1 minus 0.1 will give us your 0.9. You get that, work on the brackets first, then what's just directly outside of the brackets, the priority here is the power of 25, so it's 0.9 to the power of 25, and then multiplying that by €5 million, we get a depreciated asset of 358,949. So please use the formula here if asked. Do not depreciate every year by your 10%, and doing that 25 times is going to take too long. Okay, you'll get the same answer at the end, but please just apply this formula, and if asked, the formula will be given in the exam.